Thanks very much for that intro, Anil. I'll move into the update on Q3 for the fund. We have performance here, a disappointing quarter. The market was down almost 3% and the fund was down 5%, bringing us to negative 1% year to date versus plus 1.8% on the market. We'll see as we go through performance where the issues lie. It remains the holdings in the portfolio in China. In terms of new NS partners, in terms of the firm update, there's been some slight inflows into the product. No changes in terms of investment personnel over the recent quarter. And here we have the summary for the quarter itself. So as I said, a disappointing quarter in relation to performance. What didn't work, what hurt our relative performance over that period was stocks, both in China and Hong Kong in particular. But stock selection in Korea was negative this quarter after a very strong Q2 in that market. And we were underweight energy, which didn't help performance. Security selection in materials was a negative contributor, as was security selection in consumer discretionary, healthcare and financials. Most of that relates to China and Korea, but also some in Chile, as we shall see. Some things did work. So our overweight in India continued to be a positive contributor to performance, and security selection in India has been very strong for the past year, indeed. Also in Greece, security selection was positive. And in terms of sector, our stocks in consumer staples, industrials, and communication services were positive contributors. Individual names that stand out, the ones that hurt, well, LG Chem, it's a petrochemical business in Korea, linked to the battery business. They own LG ES, which is one of the larger battery producers in Asia. But they were hit by weak demand and lower selling prices. AIA Group is an Asian insurer that's been hit by China sentiment, despite strong results. So far, they've had a 38% year-on-year increase in value of new business. But the market's been more concerned about issues to do with China than the fundamentals for the business itself. Prudential PLC in the UK, again, this is a China oriented business, but also a significant non-China Asian insurance. And despite positive results, they're fueled by the relaxing of the Hong Kong border restrictions. That stock also lagged on sentiment. The positives, Varun Beverages, this one's been in a number of quarterly reviews. It's the Pepsi-Cola bottler in India, gaining share and introducing new products. That had another strong performance for us. In Taiwan, All-Chip Technologies is a design house. So these guys help the people who are working on AI design the chips that they use. So because of that link to AI, they've been seeing very strong demand from clients, global as well as some from China. And that had a very strong quarter. And then in India, Larsen & Toubro, which is an engineering and construction business, that benefited from strong demand in the domestic economy, but also they've got good exposure to the Gulf region. And new projects in energy have been a positive in that region. Changes to the portfolio over the quarter. We reduced some of our exposure in China, and we took some profits in Taiwan in names like All-Chip and Unichip. We added slightly to India. We added to Brazil, taking our weighting in Petrobras, the heavyweight up. We also added slightly in South Africa, reducing underweight exposures in both the case of Brazil and South Africa. This is the country performance over that period. You can see that India was a strong performer, so that coupled with strong stock selection was the positive contributor. China didn't actually underperform the broader market, particularly you see in the blue line on the left-hand side. So it was our security selection within China that caused the issue, and Brazil performed in line. You can see on the right, South Africa had a weak quarter, as did Mexico and Korea. Taiwan picked up a little bit towards the end, and we're underweight Mexico, we're underweight Taiwan, and underweight South Africa. So that's so helpful. This is the detail. I won't spend long on this because we've described most of it, but you can see there that the contribution from China and Hong Kong together are minus 1.5, maybe from security selection, while India added 0.5 with positive country and security selection. I'll skip over these ones. They're in the presentation. If you want to look at them, here you see the actual performance of some of the names. So Varun was up 16%, Chip up 45%, Larsen & Toubro 22%, and Acton Technology in Taiwan, again a name we took profits in, but that was up 39%. And the detractors were LG, AIA, Prudential. On that chart, you see that PDD was a negative contributor. That's a stock that we don't own. It sells very low-priced commodities on e-commerce sites in China. And due to consumer trading down, they actually had a strong performance over the period. So moving towards the outlook, the backdrop for us has been quite negative. And you can see from this chart that the global PMIs are starting to reflect that negative view that we've had on markets. Unfortunately, over the quarter, the money aggregates have not improved as we would have hoped. We still remain hopeful for improvements in the money aggregates, but we think now that the recession's been pushed out to the end of Q1, probably in 24. You can see from the chart on the right-hand side that Chinese GDP is growing more slowly, but it's still ahead of most of the other markets in emerging markets. So despite the fact that there's a very gloomy kind of take on China, the economy itself is responding to the better money numbers that we've seen there. Then if we look at this is showing on the left-hand side that real narrow money has slowed down in China. So it's moved back towards zero. So that's despite the fact that that's one of the better numbers in emerging markets. It's quite disappointing for us to see that move down. And that's why we retain our sort of cautious outlook. And that's why we've been trimming China slightly. You'll see also that Brazil is negative, and that's decelerated since this chart was run. India is relatively weak. The positive that I would say from all of those is that EM remains much better than developed markets. So if you look at China itself, the chart on the right-hand side shows that part of the reason why we reduced exposure, despite the fact that the authorities are looking to generate growth, and in fact, the GDP numbers this quarter have been relatively strong, the monetary data is not very helpful. So the black line that we see here, the 7-day Shibor, Shanghai Interbank overnight rate, as well as the 3-month rate, remain at disappointingly high levels. So they're within the bands, but they don't signal that any significant easing of policy is underway at the moment. Another positive that we have for emerging markets is that generally the currencies in Asia, and China in particular, are very competitive. So you can see that China over the past 5 years, its currency has become, on a trade-weighted basis, about 10% more attractive for exporters. However, Mexico and Brazil are the opposite of that. So we don't have export-oriented exposure in those two markets. Again, China, inflation is not a problem in China. It's not been a problem for emerging markets in general. And we think that when developed markets start to cut rates, that ought to allow these emerging markets to be much more aggressive on monetary policy. However, you can see that despite the fact that despite the fact that inflation in China is under control, there have been some concerns with energy and food being the dominant reasons for that weaker inflation number. Stock building, we think, is hit a low, hence our optimism for 2024 in terms of corporate earnings. You can see the commodity prices have been weak. They correlate quite well with the stock building cycle. So now that we think the bottom is in for the stock building cycle, we're less negative on commodities moving forward. So we'll be looking to add selectively to commodities as we move into 2024. This is the chart on the left-hand side that I refer to, where the monetary numbers are much better in EM than DM. But disappointingly, as you see from that, E7 has moved back from a reasonably moderate level of growth back to zero growth. So this continued excess monetary environment remains in place. Now, we expect that will come to an end in the coming quarters as inflation drops, and then indeed as global growth drops quite sharply. Both of those factors should cause an improvement in the excess monetary outlook. And we've explained this chart in the past. That would be positive for emerging markets in terms of relative performance. At the moment, if you look at the top axis, we're in the left-hand side of that. So E7 monetary aggregates are greater than G7, but we're in the bottom quadrant in terms of the global picture. So the combined E7 and G7 remains in negative territory. We don't see that moving into positive territory until at least Q1 of next year, and then we would move into a period that would be much more beneficial for emerging markets. So the strategy that we had in place on the portfolio, we continue to expect a significant economic downswing into the first half of 2024. Money markets trends are weaker in China, but they still remain mid-range for emerging markets as a whole. So we're not super negative on it. As I said, the yuan is super competitive at these levels, while Brazilian and Mexican currencies look more expensive. And that's partly due to inflows reflecting a shift for non-Chinese supply chains in emerging markets. We're less negative on commodity prices because we think that stock building cycle hasn't put in a low, or certainly very close to a low. However, that global excess money picture is still negative. We need that to improve before we expect EM will get the long-awaited outperformance that we've been anticipating. So with that, I'll hand back to you, Anil.